Um, and basically what we'll do here is we'll have a little conversation about what you guys are seeing. I'll talk to you a little bit about that. And then we'll dive into some data and we'll kind of continue that conversation about what we're seeing. For me, if you guys don't know me, I have been at Wheelhouse for over 6 years. Before that, I was a longtime director of revenue for a large organization that was mostly in the mainland. Um, and managed over 3,000 properties. So I've been in the revenue management game a long time. And now I mostly get to just chat with people about what's going on. And one of the benefits for me is, I'm obviously working with clients in a lot of different areas. And that really lets me kind of also take some of the context of like, not just what's going on in your market, but what's going on kind of like nationally. What is a bigger trend? What are other people worried about? And hopefully can kind of connect some of that for you guys. Um, I'll throw up this just screen real quick, just so for the recording there's something on the screen. But let's kind of dig into that because you guys have already started. Of like, what are some of the trends you guys are feeling like on the ground in your markets and in your portfolios? I know Russ, you mentioned that that studio garden segment is really kind of a much tougher sell this year. I heard a few people kind of mention maybe it's a little harder year, but still doing pretty decently. Anyone else want to chime in on some of the trends that you guys are seeing or anything that kind of sticks out to you from your perspective? Now that I'm recording, nobody wants to talk. Okay, that's fine. Well, I'll pop into some data. Oh, I didn't mean to stop sharing there. And we can kind of talk about it. But I think, Russ, that trend you're talking about with the Studio Garden properties is kind of an interesting one because pretty much across the country, as the consumer has gotten pressured on cost, really, cost being like a major kind of pressure piece. Um, Anything that would be considered like a more commodified property is obviously the most at risk, right? So in other markets, a lot of the time it's these like smaller apartments, smaller condos, and those are definitely seeing the biggest pressure. We pretty much across the country see a lot of stability in the luxury segment properties, right? So, if you have really nice, really specialized properties, those are generally able to maintain their occupancy levels uh, and their ADRs. Now, what we're seeing in a lot of different markets is that the more commodified properties are the properties that like this is a little different for you guys because your short-term booking is a lot different situation in Hawaii than in other markets. But they basically are hitting that kind of race to the bottom, and anything that's really unupdated is really struggling in a number of markets. So it's not a unique thing for you guys, I think, in terms of this segment struggling. And is anyone else seeing that segment kind of struggle for you guys, where you have maybe like a more commodified property type that is just much harder to book than it has been in the past, or you've had to bring down your kind of nicer properties to be more in line with their price?
Yeah, I think I'm seeing the same thing. I mean, like with occupancy being down and our island being maybe 50% occupancy at the moment, it's people are coming to Maui for the ocean, and the ocean views and higher ends are filling up, but trying to get people to to fill up some of these garden view units, regardless of, it's like I can put them down to $90 a night and it's still not moving. I could try $50 a night, but at that point, it's like if the demand's not there, are we just throwing away maybe some money that the few reservations that might come in, are we just losing the ADR in those? Or yeah, they're just not filling up these days, a lot of the less desirable ones.
Yeah. Craig, I saw you come off mute too.
I think those less desirable units, we've been constantly looking at pricing and become priced to be more price sensitive to what guests are willing to pay. So we're
Yeah.
taking it down. Um, we, you know, I won't go down so far to just try to burn and turn. Um, just it's not worth it. So we try to maintain a certain price integrity, but still we watch it really closely on those tough, tough to move units.
There's something that I think of when I think like because you guys in Hawaii, there's a lot of large property managers. Another place where there's a lot of large property managers is like the Gulf Coast, and obviously another beach location, not much more drive-in, but they're kind of in an interesting situation this year because these big property, like there's kind of a mix of perspectives. There's like certain people who are like, man, the market's really tough this year, and then a lot of the largest property and revenue managers I'm talking to are actually doing pretty darn well, but they've been really, really conservative this year. So there's kind of a trend we've seen across the country where the early booking window is just exceptionally strong. Like the super advanced booking is really good. What used to be the peak window seems to be weaker than ever. And then the last minute window gets stronger. Now that'll be a little different for you guys because your last minute window is so much different than really any other market that the United States would have. Although I'll show you in some of this data from the state, even your last minute booking window is getting significantly stronger than it has been. But it's that peak booking window that used to be the peak that seems to be weaker than it has been. And a lot of those large property managers have just been using underperforming listings to almost like test out demand in the market, like just not trying to always fill them last minute, but just putting that, reasonable, this is where we actualize rate out and not having the premiums. And that has worked really well for them as the market's changed multiple times and the booking windows have changed multiple times throughout the year. Now, feel free to jump in. I do have a few pieces of data pulled up for you guys that I think are interesting. Some of these I'll just cover pretty lightly before I hop into the wheelhouse data on specific markets. But I do have a few data points pulled up from the Hawaii tourism department. Your guys' state provides pretty good travel data. It is going to trail a little bit, so we're looking at April. But the main things I think here are they do some good breaking down of like where people are coming from and how much spend is. And the general kind of like announcement here is that overall trips are down across Hawaii slightly. So there's going to be more pressure on trying to fill these units, but overall spend is up, which is really an interesting trend. So people are spending a lot more on their trips. It's actually total revenue collection by the state is higher, but there is less people who are filling these rooms. There are less people coming. And let me think if I can remember what I was looking for here. I think there's a few tidbits that were pretty interesting to me when I was like looking through some of this data. One of them, which you guys can probably feel, is length of stay is dropping pretty substantially. I mean, it remained stable from 2022 to 2025 at over a week, and it's fallen pretty substantially. Almost 20% in this year. So this shortened trip situation is something we're seeing pretty much across the country, right? People are still planning their travel. They're still making decisions to go places and but they're doing it for less time. And so that's a big thing when you start to think about your restrictions, and especially when you line it up to that kind of longer term window, right? We know the long term window is longer. That's generally when people are keeping their restrictions up. There may be opportunities, particularly in those lower performing properties, to lower the restrictions before you lower the rate, because there's a lot more people looking who maybe just aren't seeing your property if they're restricted too far out. And so that tends to be a lever we've seen in a number of places. We're starting to see ski markets really do this, especially after the really bad ski market, which is rather than adjusting the rate position substantially, they're really removing their restrictions further out, and in some cases actually combining that with raising the rate on peak days. So like, for you guys, you have longer stays, so it's not as weekday. In ski markets, it would be like, hey, those Friday, Saturdays are going to be big, but we're going to let people book those 2 and 3 nights much further out. There was another little tidbit here. As you guys probably know, Japanese travel has not really ever recovered from COVID, and it remains pretty static. They're also coming for shorter periods. There was some interesting things out of China. Chinese travel has never really recovered. And when you look at Australian stuff, Australia is really taking travel from these Asian markets from the US. So these feeder markets that were previously, East Asian international travel, they're not recovering strongly, and it doesn't look like they're in a position to recover well. It seems like the current environment for international travel around the country is pretty weak. International travel is down around the country. Obviously, certain demographics are bigger than others. Canada is down almost 75% in the nation. And so that's something that we probably have to continue to expect to be weak. Now, for you guys, Canadian travel is down a little bit, but it's not down near as much as, say, like the Northeast United States and the Northwest United States, where those travel crossings are almost non-existent. That demographic is basically gone. But I think we probably want to consider that international travel as a source is going to be a lot weaker. And even if your portfolios don't have international travel as a major component of them, it does mean that the kind of properties that they were filling are going to be priced competitive now to try to make up for that missing occupancy. So always something to think about. It does seem like that international travel situation is going to be a problem going forward. On the bright side, there's kind of an interesting thing here, and this is a trend that I'm absolutely seeing around the country. So one of the highlights out of this, report by the governor was that they're seeing U.S. East Coast travelers as the largest growing demographic of travelers to Hawaii. So you're seeing people from New York, from Massachusetts, from Connecticut. These are generally pretty high income travelers choosing to come to Hawaii uh, at much larger numbers. So that's the largest growth, and it was pretty substantial percentage growth in terms of travelers. You can see this little spike here if I make this graph. Maybe it's a little smaller. Pretty substantial spike in 2026 in terms of arrivals from the US East. And the trend here, I think, is this is something that I'm seeing across markets in the US, is first time travelers to markets are up in almost every market. So what that indicates to me is that people are still planning their travel. They're still planning to take a vacation, but they're way more flexible about where they want to go and what fits their budget. So making sure that you have properties priced for all these different budget kind of options throughout the year so that you can capture these bookers is going to be really important, right? Because there's a ton of new people coming to different places. And I think for kind of on the marketing side, a big piece is like, how can you get those people to come back to you? Because a lot of the time, there's I'll use an example of like Panama City Beach because they have great visitor statistics that their CVB puts out. Their first time traveler at Panama City Beach is up like 20% this year. But when they ask people what their favorite beach is, it's about the same. So people aren't going, and there's tons of other stuff ahead of Panama City Beach. So people are choosing to not go to their favorite place. They're choosing to go to a new place. Now, of those first time travelers, more than half said they're interested in coming back to that market within a year. And 25% said they're interested in booking another trip in the current year. So there's a huge opportunity to be finding these like new travelers because right now I think the consumer environment is that people are going to take the trip. They're just not necessarily going to go to the same places. And I think that's why we see these Northeast travelers. These Northeast travelers would go to Maine. They would go to Maryland. They would maybe go down to Florida. And when we look at the revenue management situation, especially for the Northeast and the Atlantic coast, those revenue managers aren't that reactive. So those are expensive places to go right now. And so those travelers are looking for other opportunities, right? Anyway, that's enough I'll say on that right now. Anyone have any thoughts or comments, or does that seem to resonate with anyone on what they're saying? Anyone disagree? Anyone think it's useless? All right. I'll drop this link in here just because they update this. Right now they're up through April, but it's pretty useful. I always find like using third-party data is useful. I'll obviously show you the wheelhouse stuff too, but whenever you're talking to owners and things, it helps to point to other stuff because, if your owners have anything like the owners that work with me, they like don't believe it if I say it, but if someone else says it, they'll believe it. Um, Now this is also from a Hawaii travel organization. They did some really big surveys. I'm just going to point to a few things here. This is a pretty long thing, but I think the thing I'm just going to point out here is the growth in price of airfare and price as a decision-making thing, right? We've seen this jump up pretty substantially, and I think we're going to continue to see this. So as you guys probably know on the ground, the consumer is super price sensitive right now. And this ties into consumers looking at other markets. I've seen markets that traditionally have a shoulder season in the summer suddenly are having the best year ever because they're priced well. And travelers, instead of going to a summer market, are coming to a shoulder market that's still nice in the summer. So there's huge opportunity to drive new consumers if you're just priced effectively throughout the year, not just looking in like your current booking window, but make sure you have like reasonable pricing around the year and that your product, ideally you have some variation of product because if someone gets to your site looking at like a more expensive product, but it's out of their budget, there's still a cheaper option and vice versa too. A lot of people, if they come to your site, or they see your properties and they get there from maybe a cheaper product that drew them in, they may still decide to be like, hey, it's only $100 extra per night, across 4 people to get this like way killer property. And so one of the things that I think our industry consistently has a problem with is being overpriced, especially outside of 60 to 90 days. It might be a little longer for you guys because you have a much longer booking window than most people across the country. But generally speaking, outside of that primary booking window, this industry is overpriced all the time. The market level, not necessarily in your own individual portfolios. And I think one of the things that we've seen across the markets that are really doing the best this year, despite the fact that like market level data maybe looks a little tough, is those revenue managers are taking a much more conservative approach and they're taking it on the year. They're saying, hey, where did we actually actualize? Let's make sure we're not posting rates more than, 5, 10, or 15% higher than that unless we have a really specific reason to do so. And let's try and drive that early booking window, which seems to be so strong across the markets. Um, Something else in here that I was gonna look for, which I thought was interesting, but I might not remember what it was. I mean, this one was kind of interesting. We're still seeing cost breakdowns as the number one thing, but this has some good information just about demographics of who's coming, where they're coming from, um, and generally, just a good thing to look into. Okay, cool. So let's hop into some markets and some market data. Before I jump in, I think we have, I'll start with Maui, but does anyone have any thoughts on what I've said so far, or have noticed anything unique in their portfolio, or have maybe even something you've been doing this year that seems to be working really well? Russ, I saw you come off mute. Did you mean to do that?
Yeah, we just, we've been um, shortening length of stay, some restrictions. Obviously, we've definitely been going in from, I'm more on the distribution side, so we definitely been going in and just moving pictures around, tweaking pictures, putting in more drone pictures, bringing them up closer to the front. Um, just, we've at some point with a slower moving inventory, you are where you are, and you don't want to go any lower on rate because it just starts to get a little ridiculous. So you're trying to, pull some other levers to see if you just can't get a few more eyeballs on it and move in that direction.
I think that's a good point. Like, I often tell this to people as a revenue manager, which is rate is really a triage. If you know that the rate value is pretty correct for the most part, then changing rate, you're really just trying to react to something in the short term. But the solution to the problem is usually somewhere else. And that's going to be, is your distribution good? Is your value proposition good? It can be rate, but it usually means it's like across the board, like, is the rate strategy correct, right? Is the price you're offering at any given time right? And how early, Russ, have you been adjusting those, minimum length of stay restrictions and things like that?
Well, we're certainly doing, anything in the next 90 days type deal. And we still have our pretty typical, we're even doing it out into, some in November. We still have holiday and Christmas at, typically what we would have in previous years. We have to couch against, especially because it's a tough year for most folks, that they'll owners will get quite upset if they book a holiday time period at a lower rate than they booked last year's holiday time period. So we definitely got to be very cognizant of that. But I think we've just trying to, look at last year, keep rates maybe 6 months out. You've got some premium on there, but you try to change it a little bit right outside the holiday time. If you previously had a 6 day, length of stay type deal, maybe you drop it to 5 or even 4. If you're outside, early December is a very slow time for us and always has been, pre-COVID even. There's 2 weeks between Thanksgiving and we try to do everything we can to get some early bookings on those time frames because we know we'll likely fill up holiday time, but to
Hmm.
get those first 2 weeks of December with something on the books for a fair number of our units is it makes their December just flesh out a whole lot better.
Yeah, that makes a ton of sense. And I think it's also a good place to look where if you're
Thanks.
like, you are trying to convince owners or even convince yourself if these things can be helpful, the easiest places to start are the places with limited risk, right? Go look at your occupancies across the year and find the weeks that are traditionally low occupancy. That's a great place to drop your restrictions instead of 90 days out, 180 days out and see if you can increase your overall revenue, right? Because there's limited risk there. If they're not well performing times, really all you have is the opportunity to do better. And so you can do these experimental strategies because it makes sense. We're like high season. It's like maybe I'm a little nervous about just like ripping off restrictions or making big changes to my revenue strategy. But start in those time periods that are traditionally low occupancy. Because if you can increase your occupancy by 3 or 6%, that's pretty substantial. And it gives you a little more confidence to plan that strategy for other time periods. I think the same thing applies to properties in your portfolio that haven't been doing well. If you have properties that are consistently selling in the lowest booking window, that are selling under what your rate position is, those are great ones to just make adjustments to because generally speaking, you're in a position to only be able to do better. And so if it doesn't work, it doesn't work. But if it does work, you can then fine tune that to be like, well, how does this apply to my properties where I have less room to make a mistake because they are doing well? Um, Okay, well, let's take a look at some market data. I've got Maui pulled up first. I'm going to pull up the trends section here. And this market data, just so you guys know, is in the Wheelhouse Market Reports. This is all market data that is available for free, whether you're a Wheelhouse customer or not. So if you like some of the visualizations or you want access to some additional market data, you guys can access this, whether or not you're a Wheelhouse customer. It is going to be pretty high level. We're basically looking at the whole island, whole market. I will filter down a little bit, but I think for just getting an idea of what's going on, usually this is like, you know, this is going to be enough to give you that kind of strategic perspective you need to make that you're going to translate down into your tactical level. So I've got occupancy pulled up. I've got adjusted occupancy pulled up for the whole market. And right now I'm just kind of looking at 2024 and 2025. This shows the monthly occupancies year over year. And, we're looking at last year just to get an idea of kind of what's going on. I won't go too deep into it, but I think it's pretty clear, just looking at these two lines, that generally speaking, last year was at the market level pretty rough across Maui. Like pretty much most markets were down, or sorry, most months were down at some level in occupancy. Given that occupancy is down, usually that means everyone's down in some way, often coincides with rates being down. But pretty much we saw consistent pressure on the occupancy last year. And that's true for every month of the year. And then in Q4, it gets a little worse before it gets a little better. So that holiday season really makes up for some of the weakness of, I guess, quarter 4. But we see that starting in September, this kind of pressure on the occupancy increases. And interestingly, that is not a Hawaii specific problem. I don't know the cause. And now we're getting pretty far away, so I don't even remember totally what was going on in September. But pretty much the entire country saw pretty substantial pressure in September and through the rest of Q4. So that kind of extra pressure shows up here, but you guys were already under pressure in Maui across the board. Now, if you're wondering if these occupancies look a little low, we are looking at the entire of the market. I'm going to filter up to the high performers, which I think is generally a little bit better. Kind of like if you were using this to talk to owners, I would use the high performers because those tend to be more professionalized. When we look at the entire market, we're looking at, every person who has a listing up and might be looking at stuff. So as I switch this to the high performers, we do see that these overall occupancies are substantially higher, right? There's obviously the top 15-20% of the market is operating at a commercial level and has significantly higher occupancies, but the general trend is the same. Right. So even though these folks are taking a higher market share, these professionals and top performers are taking a higher market share, we're still seeing pretty consistent pressure across the year. Now, some of that gets mitigated, right? Starting in about April and through the summer, we don't see as much pressure. So my thought here, which we often see in markets, is if the market is down, the professionals and the top people react faster and are able to take better market share and stabilize their occupancies. Through the rest of the year. And I think we see that here, right? So the market generally was down the whole year at the market level, but professionals were able to stabilize their occupancies a bit as we got into April through the summer after kind of seeing what was happening in Q1. Now, we do still see some of the weakness in Q4. Again, potentially a national trend here, but even September was looking a lot stronger. And overall, the top performers, maybe not a great year, but those top performers were able to react. And I think it's kind of through some of the things, the behaviors Russ is talking about, right? I hear this a lot from professional revenue managers. We're getting more conservative on rate. We're trying to take advantage of that early booking window. We're removing restrictions. Okay, let's take a look at 2026. I'll leave 2024 up for now, and then let me get a little pen out. Let me draw on this. Okay, so interesting thing looking at Q1. Kind of a mixed situation here. I would say on the whole, it's a little weaker, right? But maybe stabilized, right? We're a little bit up in February, a little bit down in March at the market level, a little bit down in January. So that weakness from Q4 kind of extends into the beginning of the year. And now you guys have a Q1 high season, and a lot of the other markets we see with Q1 high seasons, they still absorbed some of the weakness that we saw basically across the country in Q4. As we get a little further in the year, we see that the market is down a little bit, but still stabilizing maybe to the spring. We're just down slightly, nowhere near as big as from 2024 to 2025, but still down a little bit at the market level. And then we'll get into summer pacing a little bit more. It looks like pace is going to be pretty good, but at best, it's going to be maybe stabilized to 2025. So it seems like we're really missing some of these chunks of consumers that were coming. There's just less kind of stay available. That matches what the governor said. We're seeing less stays, but people are spending more, right? So the overall revenue in the market's up, but there's less to go around. And usually when we see a trend like that, what we see is the top performers are taking more and more of the market share. So we're in an environment, and this is true across the country, where the most professionalized revenue management organizations and most professionalized property management organizations are doing significantly better than the market at large, which means a bunch of people, it's kind of like a feast or famine situation. A bunch of people are really getting hit by what's missing, and other people are taking a larger market share. Sorry, someone's coming in. And I think we see that here in the high performers, right? Q1 looking a lot stronger, still down a little bit, but not quite as much. Overall occupancies are significantly higher. Spring has some kind of stabilized strength, and we're in a better position for June and July in terms of how much is on the books already. So I think that's a trend that you can kind of expect is like if you know who the kind of top revenue management organizations are on your islands and around you, go look at what they're doing. Make sure to follow what they're doing. We live in an environment now where you can go use AI to scrape their stuff and get an idea of what they're doing, because what tends to be happening is the top performers are just taking more and more market share, and you want to be in that group because the bottom performers are doing significantly worse generally. Okay. Any questions so far? Any thoughts on that? I'll come into the pacing here real quick. Just on Maui, we're seeing that this is at the market level, not in the high performers. June is starting to fall behind a little bit in terms of overall occupancy pace. July remains up a little bit, and then August and September are both up. And this is a trend that I've seen pretty consistently across the country, and it goes to what I mentioned about your like what used to be the peak window is under a lot more pressure, and early booking is really strong, and last minute booking can be strong, but it's not necessarily strong enough all the time. And what's happening here is we see that early booking is giving these big pacing premiums. And so when we coming into these months, we're seeing that things, can be pretty strong from a pacing perspective, but within like the 60-90 day window, it's eroding, right? And that slowdown is really the critical piece for the revenue manager. You need to make sure that you're keeping your booking velocity going in order to get to the end, because when I looked at this earlier in the year, June and July were up like August and September in terms of like pacing premium. But they erode in the 60 days, and that happened through the spring. It's happening in most markets I'm looking at. And there's that kind of middle window where pacing is eroding, and the best revenue managers in the space are just making the adjustments to rate they need to maintain the booking pace. And so, however you want to track that booking pace, the number of bookings you make per week, the number of stays that you're putting on, the occupancy gains so that you can get to that kind of goal occupancy, you just like you got to understand that the rate is the lever to maintain the occupancy growth, right? And this is where like you really have to compare this to what's going on in your portfolio, right? Because if you're a portfolio who's pacing really well, you're probably not going to make rate cuts. And especially if you're continuing to sell every week, you probably keep doing what you're doing. You might even be able to raise rate. But if you're like well behind what you were doing last year, you probably need to make a much bigger adjustment to get caught up. Because as we see in this trend, and I think we'll see this across the board in terms of an overall trend, um, that pacing erodes in this 60-day window. And what that means is if you're behind and you're hoping for it to just catch up in the last minute, you're probably going to be in a tough spot. And I think you guys already know that because you're already in a market area where the last minute is not near as strong. Now, what I was looking for earlier was, I can't remember where the chart is on one of these, but there was a good chart showing how much the last minute booking window has grown. For your market, it's more like 30-day is the last minute rather than like 7. But it's grown from like under 10% to over 20%. So there is a lot more travelers who are booking in the short term. There's a lot of opportunity there. What you want to make sure is that you're not relying on that because that's also the most volatile time for rates. We can look at some of this information here. If we look at lead times, and we'll just go ahead and look at July right now. July lead times in 2025, we're still making quite a bit further out. But let me take a picture of this. This will be easier to see if I do this. Where did that go? Where are you? There you are. So I'll give you just the kind of picture version because a lot of the time looking at trends is, what the heck? There it is. Why is it doing this? Sorry, my window sizes are all messed up now. Okay, so, and let's do that. This is 2024 here. This is 2025. If you look at just the shape of this curve, this has a much smoother, far out curve. This is very compressed, right? You can see that this booking window has shifted from here, has shifted into here, but we still have points of really strong early booking. And I think that's kind of talking about what I've mentioned a few times at a general level, which is even though the booking window is getting shorter, we're still seeing a lot of strength in these early booking windows. And the strategy you have to have is if you need help stabilizing your revenue, is you really need to be looking at those further seasons and taking advantage of that early booking window, right? Especially, the opportunity there is with those properties that have been underperforming. They're very easy for you to put out there at different rate positions, at different restriction positions, and see if you get those gains on those properties and then apply that to the rest. But when I talk to the revenue managers who are looking in markets like the Gulf, those top revenue managers, they're talking about fall right now. They're looking like almost an extra season out and are trying to drive the occupancy there because they put themselves in the position for their summer to already be strong in the spring. And because of that, they can absorb when the booking window starts to get weaker here. Let's take a look at another market. Only a few of you mentioned where you guys are. I know a lot of people were in Maui, but I want to see what similar trends we're seeing. What other islands are you guys in right now? Otherwise, I'm going to choose Oahu.
The Big Island of Hawaii,
Big Island. Okay.
specifically Kailua Kona area.
So I've got Big Island here. I'm going to keep the kind of island level market reports. We do have neighborhood level data. I just don't have it prepped, so I can't get to it. But if you do want to see how to get to that, feel free to hit us up, and we're happy to show you how to access like very specific neighborhood level data for your properties. Let's just take a look at some of these trends, overall trends, and see what's going on here. So generally, year over year at the market level, a little bit stronger in Q1 than Maui. Maui's been recovering for the fires. This report actually has some really good information about that. But we do start to see this weakness. And interestingly, this weakness aligns a little bit more with national trend. The national trend was that starting in spring, things started to get pretty weak across the country. pretty much across the board. But we see this weakness starting in about March, which matches a national trend, and then kind of continues through the rest of the year, except for the holidays, which maintain at the market level. We see that Q4 again has a lot more weakness. Like starting in September, it drops quite a bit more, and that retains being pretty weak further out. As we get into the highest performers, we see, well, pretty similar in terms of meeting that weakness, although they were doing much better in Q1 when things were pretty good. Now, if we go into 2026, I think the thing that's sticking, let me put this back at the market level instead of the high performers. This is kind of interesting here. So we see a little weakness in January and then a little bit of strength through the rest of the spring. When we look at the high performers, even though market occupancy is higher, there's a little bit of weakness in February that wasn't there. So this is what I would call trading down. There's the potential that consumers are trading down into less valuable properties because we're not seeing quite as much pressure in the high, like we're seeing more pressure in the high performers than we are at the market level. So a little bit different than when we see like the high performers really just taking the market share. There's another trend we sometimes see where if the consumer is really cost conscious or the market maybe isn't reacting in price very well, they're trying to push price too high. We still see the consumers coming, but they trade down into lower value properties, right? And that means, you know, to me, it really indicates that there's like a strong price sensitivity problem in the market area. And we'll look at some of the asking rates in a second. That does seem to recover as we get through the spring. In the high performers in particular, spring's looking pretty decent from an occupancy perspective for both the market and the high performers. But getting into the summer, this is generally lower occupancies, you know, seasonality. Like this is a much stronger Q1 seasonality than what we were looking at in Maui. And if we look at the pacing situation's a little bit better, right? And this is partially probably because occupancies are not quite as strong at the market level here. We still see the same trend where further out we have much stronger pacing premiums. They start to erode in the short term, although July is a little bit more ahead and June is not fallen behind. But again, it's right on the razor edge. Now this makes sense. We're at the end of June now, but essentially, we're still seeing that same general trend. And I bet you we see this everywhere. I'm seeing it on almost every market I look at. It's that those premiums are like market performance for individual clients is being bolstered by their ability to capture good bookings in the early booking window. And I think that that's a story you're going to like everyone is going to carry forward into next year, which is the best way to succeed is to take advantage of that early booking window where rates are still really strong, but maybe not as much of a premium as people would have posted in the past because you need to beat out everybody else. And it doesn't take much to be a better price than everyone else in the market. If I pull up something like asking rates here, asking rates are kind of averages of advertised rates. So this is a little different than ADR, which is what's coming in. Asking rates is like where occupancy gives you an idea of the demand in the market, right? Because it's how many stays and how many booked nights are kind of getting shared among the properties. Asking rates is how the market is positioning its own pricing, right? How people are positioning themselves in the market this year. And the general kind of trend here between last year and this year is rate positions are generally higher, right? At the market level, right? The market is pushing rate position overall. Compared to where things ended last year. And the fact that these past months remain higher also indicates that the market is not really adjusting a ton in response to what's happening from the occupancy. And so in order to bring this down to like your individual property level, you have to do a lot more work at like specific exact bedroom count types. But I think the general story here is that a lot of the peers you're competing with are probably pricing too high in general and maybe not reacting very much to the actual occupancy situation that's on the ground, right? They're setting their price and it's a little bit unlinked from what the consumer is doing. And what that means is there's a lot of opportunity here for you to take market share by just undercutting the market, right? You may not have to make big moves. And this is true further out as well, right? Like when we look out here, there's not much different behavior further out than in the past. So it's not being very reactive. And this is what really strikes me is the further out we get, the higher these premiums go. And I think what's happening is a lot of people like just aren't focused on this time period, so they keep high premiums to protect themselves. But that means for you, if you're trying to drive this early booking window, and we know that there's people who are looking, you may not have to do much to be competitively priced compared to your peers, right? Now, the big question is whether or not you're competitively priced to other markets they may be looking at, right? If the Northeast is one of the biggest growing segments of people who are coming to your area, they're probably looking at the Carolinas. They're probably looking at you know, areas of the South that they could go to as well. You can't track all of their pricing. But generally speaking, even just thinking through like this is the zone where these professional revenue managers who are having a lot of success, even in difficult markets, this is the zone they're looking. They're looking in that 4 month to 6 month and 6 month to 9 month. And they're not doing work on it every day, but they're paying attention to it and also tracking their pickup there because they have a hunch that if things are tough or things get worse, that if they have a really strong base of business there and they do it at a good rate, that they're gonna be in a great position when we actually get to those months. Any questions? Any thoughts? Craig, what are you seeing in your portfolio in Kona?
Um, we saw some of the actually Q1, actually all the way through April, a big uptick from the previous year. 2025 was, crazy as we talked about, but we definitely have seen this year uh, all the way through April. April was kind of at parity, if you will, but then we've seen a strong uptick through July in our rate and occupancy.
Let's go.
August and September are down a little, but we're pretty pleased with where we are as of this moment. So,
Greg, larger size properties in your portfolio or a little bit of everything?
we've got a little bit of everything from, beachfront houses for 3, 4, 5 bedrooms to oceanfront studios. We generally try to focus on ocean view or oceanfront properties and
Right.
stay away from gardens and things. So
Craig, do you get the feedback from your guest? How much do you think the on and off and, pretty active volcano activity is helping you? Obviously, you're on the other side of the island. Are those folks coming and staying with you and doing all the things, Apuna Beach and all the other things that Kona side has, but also maybe a day trip over to the volcano, you think, with all the activity?
we the only people that we really hear from regarding the volcano activity is people that have respiratory problems, in which
Oh,
case
okay.
they don't want to come, and
Got it.
we accommodate them and give them an opportunity to come in the future.
Right.
Uh, the I think because of the publicity, more people are coming and staying over on the Kona side and making those day trips or going over for a night
Right.
over on the Hilo side. But it really hasn't adversely affected the occupancy as much as it
No, I
has
almost
in
look at it as
past
the other way.
years.
Yeah, no, I almost look, yeah.
But
We're not seeing as much fog, or I'm not hearing as much fog here on Maui. So I was
right,
thinking, are you getting a little bit of an uptick? Because people will stay on the Kona side. They know they're going to get the western sunsets and all the things that
right.
Kona side has to offer. But hey, we're there. Let's head to the volcano a day. It's been an active year. Maybe that's one of the other reasons they, choose Kona maybe over Kauai or something like that. They get all the normal Hawaii beach snorkeling. You've got lots of cultural stuff on the Kona side, and they also the added plus of maybe we'll catch the volcano side one day. So
The added activity or increased activity of the volcanoes since December has definitely created an interest, and people are taking day trips over there.
very
So,
cool.
um, Where before, 10 years ago, people used to say a volcano erupts, everybody leaves, and runs away.
Yeah, yeah.
In the last 5 years, uh, a volcano erupts and everybody comes.
Okay.
Volcanoes don't seem so bad anymore. Um,
Exactly. Well, and they're pretty. I mean, in particular, since December, the activity, I think we're up to 76 eruptions, which is
cool.
quite active. And so your chances of going there one day or one evening and seeing some pretty significant activity is pretty good.
Yeah.
Yeah. I do think it's an interesting thing to bring up, which is something I talk about a lot in other regions, which is because consumers are really appear to me to be looking at multiple locations, it is very important to understand, at least at a high level, what's going on in the markets around you. So for you guys, if you're in Maui, you do want to pay attention to what's going on the other islands. And it doesn't have to be like super detailed, right? Because it's not apples to apples. But the big thing you're looking for is if one of these markets is down substantially, um, that could cause you a problem because if their revenue managers are down and they're suddenly dropping rate, now anyone who would have been looking at you, who's probably looking at other islands, may decide to go to that island. So there's a little bit of trading going on, right? So, you know, um, the Big Island been doing pretty good, right? So probably not going to undercut you. But for people on the Big Island, you might watch Maui, right? There, that market's under a little bit more occupancy pressure. And so if those revenue managers are really dropping rate a lot, that may affect your booking pace, right? And kind of paying attention to just, are there other markets around you that are going to potentially take like siphon consumers off of you just because they're under more pressure or under less pressure, right? You can kind of do the opposite. I think it works better when a market's under pressure, but if you see a market's really doing really well, you might be able to kind of hold your rate a little bit more. I think that's more like if all the markets are doing well, you might be able to hold your rate a little bit more. The situation we're currently in is it seems like there's just generally more pressure perceived from most people, and you really just want to watch for like, are these markets starting to fall off, right? Like, do these months start to fall? Does that mean their revenue managers are going to start to drop rates and drop restrictions? And are they going to start to siphon consumers off of myself? Now, one thing I do want to ask about, do you guys, because there's such a large increase in last minute stays to this market region. Are you guys seeing people like go to multiple islands? I know airfare is still a little expensive, so I would be not be surprised if we don't see that. But I am curious if people are going to multiple places on trips and like taking shorter trips in each place, but actually like telling you like, oh, hey, we're gonna go to Maui after this, you know? Just
Anecdotally, it feels like we hear it more, but the data when we look at 2 and 3 night stays and stuff, that's not really, it's still a tiny, tiny bit of our nights booked, and it doesn't
yeah.
seem to have increased a lot. But in theory, like people talk about island hopping more than they did, a decade ago, and just in my experience, I hear it more, but yeah, I just haven't seen it in the data as much.
Yeah, I wouldn't be that surprised if it's not a big deal. I mean, my mom was, my mom goes all the time and she has to go between Oahu and Maui, and she says it's pretty expensive to do the island hopping too. So it's
Yeah.
not like a good deal. But I have
And year over
wondered if
year, that hasn't changed much. And what's weird is what spiked up for us is 7 night stays, like exactly 7 nights have gone up a bunch. I mean, it's always been our biggest, in terms
Mhm.
of our most frequent stay length, but it's gone up even more this year, which is interesting. And our length of stay has actually gone up a tiny bit year over year. And even though we've kind of reduced length of stay restrictions down to, we're pretty much the rest of the year down to 3 nights, and then kind of going up to 7 at high season. We've got a little bit higher for Thanksgiving, but even with all these like reduced length of stay, we're seeing actually an increase in our average length of stay.
I don't actually think that's an accident in the sense that like what you're bringing up there, Leo, is really interesting because when I talk to these other markets who have traditionally long stay lengths, and have been really resistant. So like a good example is Carolina. The Carolinas and the kind of mid-Atlantic coast, they really do not want to drop their restrictions. And what we find in the companies that are dropping their restrictions, they don't lose a lot of ground on the length of stay, but they are so much more available. So it's like it kind of goes the other way. If you're a millennial or you're a younger traveler on Airbnb, you may not think to look for 7 nights or you'd rarely do 7 nights. And so you'll look for like 3 or 4, but you still may book 5 or 6 or 7. You know what I mean? And I think that, obviously I don't have hard OTA data to prove this, but I think that the dropping the length of stay is really much more about being visible than it
Yeah,
is
that's what
about
I
like getting
think.
the
It
lower
kind of
stays.
gets us up maybe in the search results, but people aren't actually looking for it and booking it. But for some reason, the search algorithms like it is kind of all that I can glean out of that.
We
But
Yeah.
again, that's just kind of
absolutely.
guessing. Go ahead.
Well, we definitely have found that. We've played with our length of stay this year and um, lowered it to 3 nights in some markets, and we found that we have very few 3 nights, but we get a lot of 4 and 5 nights. And so, Leo, to your point, I think it's just the visibility, and people
Yeah.
aren't necessarily looking for that 3 nights, but it shows up in their
Yeah.
searches.
And even in Maui at this market data, it's like this is the 2024 booking window, this is the 2025, and you can just see this like 2, 3, 4 is bigger. These maintained kind of their position. And you kind of lose a little bit out here, but there is it's not a huge increase, but there is a small increase on particularly this 2, 3 night stay length and a little bit on this 4 or 5, and then but 5 and 6, 5, 6, 7 is kind of staying pretty stable. You know what I mean? And I think, that's really the big kind of like advice I would give is find ways to open up your restrictions, not necessarily to take lower stays, but you need to be available. This is something I say to the Carolina folks all the time because they have like Saturday to Saturday restrictions. And it's like new consumers don't know what restrictions are in place in the market. And so you need to appear available to them so that they can see your properties and they may still decide to book things, or you can adjust your pricing so that you're roughly making a similar amount of money. But like, there's a lot of new travelers going to locations right now who haven't been there and they don't know like the traditional rules of like, oh, generally people stay a week or longer here, or generally people have to check in and check out on a Saturday or something like that. Like those new travelers that are enabled by the OTAs, they don't know the rules. So if you can just be available or at least have a portion of your properties that are available so that when they like get to your brand, they can see everything else and you can explain it to them there. I think that's just a net gain. And it's really, I think, going to be one of the major kind of like revenue management themes that we see in the industry at large, because there's a lot of markets where like the traditional demographic is aging out, right? Like millennials now are becoming one of the largest traveling groups. They are the family group. They have different buying patterns. They're more willing to try different places, and they don't necessarily have the history of how like, their parents or their grandparents had just traditionally booked the same stuff year over year. And so being available and showing availability is a huge revenue management strategy for your long-term strategy, even though it's a little bit more distribution oriented than it might be pure revenue management pricing oriented. Okay, guys. Well, we're a few minutes before the end here. Only got through a few markets. If you want me to dig into something for you specifically, let me know. I'm happy to do so. Or if you want to meet with our team, we can pull up some neighborhood data with you and kind of show you what's up. We'll probably do another one of these on the Hawaii markets. As we're getting into, the fall, just to kind of see how Q1 is booking and the spring. And then just so you guys know, a lot of this data was available for free. We also have a data tool available for free that shows your own pace. So if you need more tools to see how you're pacing and how you're comparing to year over year and same time last year, all you have to do is link your Wheelhouse account. We're happy to meet with you and give you some training, and those are all free tools as well. And then last kind of thing, if you're interested in building cool data stuff and pulling data out of our APIs, we have a brand new consumer API that's super cool, and we're happy to provide training on that so you can just kind of build your own BI and get data out of our system. So anyway, hope you guys found this helpful, and let me know if you have any questions afterwards, and then I'll hopefully see you guys again soon.
Thanks,
Very
John.
good.
Thank you,
Thanks,
John.
John.
Thanks, guys.
Bye.
Have a good one.
John.
Thank you.